Today we're going to have a discussion on the balance of payment. We've discussed a number of aspects regarding international trade, that is, exports, imports of goods and services across international border, of which also money or funds are involved, right? How do you keep or how do you maintain a record of your purchases, a record of your sales, a record of, let's say, some loans that you take, or retained earnings? We use accounting procedures to keep these records at a small business level. The same applies to even a partnership business and a company. Equally, at the country level, we need to keep the record of different transactions that occur between residents of different countries. And these transactions are kept or recorded in the so-called the balance of payment. To begin with, how do we define the balance of payment? The balance of payments simply means a statistical record of countries' international transactions over a certain period of time, presented in the form of double-entry bookkeeping. Remember, bookkeeping is the basis of keeping the records or the books of accounts. It's the basis of recording different transactions in the books of account for any given business. Likewise, the balance of payments apply the use of the very same techniques. That is to say now, each debit transaction needs to have a corresponding credit transaction. Simply say, double entry bookkeeping system. Consequently, the sum of two sides of the complete balance of payment accounts should always be the same, and in a sense that the balance of payments needs to balance always. In case there is an imbalance, then we're going to learn some techniques that we're going to use in order to balance all entries in the balance of payment. But most important to remember, the BoP is prepared following accounting skills, the entry techniques, where every single credit transaction needs to have a corresponding debit transaction, and vice versa is true. International transaction simply means an exchange of goods, services, or assets between residents of countries. That is, the movement of goods and services across international borders. Now, since I have mentioned that in the balance of payment, we record all transactions that the country have conduct with other countries, then in this balance of payment, we are going to as well include not only goods or services, but also movement of assets, as well as some funds, okay, let's say some grants, etc., across international border. So when I say the residents can be citizens of, let's say, Tanzania vis-a-vis the world, because we do not transact with just one country, let's say Tanzania vis-a-vis South Africa, Botswana, etc. No, we transact with the entire world. Now, residents includes businesses, individuals, government agencies that they make the country in question their legal domicile. This again is very important to understand, all right? Residents includes businesses, individuals, and government institutions or government agencies that make the country in question their legal domicile. So we might have, let's say, Tanzanians who are legally living in the UK. That is to say now, UK is their domicile, and so they are the residents of UK. But as well, we know we have Tanzanians who lives in Tanzania, and so they are the residents of Tanzania simply because the country is their domicile. Likewise, in Tanzania, you might have some individuals from different countries for different purposes. You might have businesses from different countries that have their foreign direct investment in Tanzania. So they will be considered as the residents of Tanzania. Again, if a Tanzanian company have an FDI, let's say in the US, UK, Kenya, Uganda, etc., then that FDI is considered as a resident of those particular countries, even though its headquarters are in Tanzania. Therefore, when foreigner gives up an asset to a resident of Tanzania in return for a promise of future payment, a debit entry is made to show the increase in the stock of assets held by the Tanzanian resident, and a credit entry is made to show the increase in Tanzania liabilities to foreigner. Simply say, there is an inflow and outflow of an asset. Therefore, it has to be recorded in the balance of payment. More on this in the coming slides. Now let's see the significance of the balance of payment. What is its relevance? Why is it so important? Or does it have any importance at all? The balance of payment can be used as an indicator of nation's economic stability. You must have heard, let's say, the Minister of Finance and Economics, the President sometimes, some member of Parliament arguing or discussing in the Parliament, or the President talking to the public on the importance of inviting foreign investors. Foreign investors will not just come following an invitation from, let's say, a president or any other politician. Before they embark to invest into our countries, first of all, they will have a discussion, and among other things, they will as well try to see the economic stability of the country in question. And much of the information as well will be obtained from the balance of payment. That is to say now, they will scrutinize different accounts of the balance of payment in order to further comprehend and even to predict, to foresee, to forecast the economic condition of the country that they intended to embark into in order to open their businesses. So balance of payment is an important tool in invitation of the foreign direct investments into our countries. Changes in the balance of payment can affect the exchange rate of countries' currency. One of the issue, or one of the accounts in the balance of payment is known as the currency account, in which we record buying and selling, or let me put it this way, export and imports of goods and services. Now, we all know that if you export more, most likely even the exchange rate of your country's currency will appreciate relative to your trade partner's currency. Therefore, it's important to note on the balance of payment simply because the currency account that I have mentioned has a significant impact And also, the terms of trade of your country has a significant impact on the currency exchange rate. A current account deficit means that the country cannot meet its current overseas expenditure from current overseas earnings. That is to say, a current account deficit occurs when exports is less than imports. It means that you are not selling more, rather you are importing more. And so, most likely, you're going to suffer. Now, the deficit implies that you might run into some difficulties to continue to import, to buy goods from abroad due to lack of some funds. That's the reason we say the country is therefore either increasing its foreign debt or running down its reserve, or both. Why? Because if you do not have funds to finance your imports, you run to make some international borrowing. That means now the country's external debt will increase due to foreign borrowing. You borrow money from other countries, or you may decide to use your foreign reserve or official reserve. Okay, you use official reserve to finance what? To finance imports. Significantly, you will decrease your you will decrease your official reserve. In the worst case scenario, you might find yourself, a country might find itself compelled to use both foreign borrowing as well as official reserve to finance its level of imports. And that would be even much worse. A short-term deficit is considered less harmful so long as the government can use the reserve to finance it. However, a long-term deficit has more serious implications because it involves using more of the official reserve or increase the foreign borrowing. And if you use more of the official reserve, as I mentioned earlier, significantly, the official reserve is going to decline, and foreign borrowing, due to excessive foreign borrowing, the country's external debt will rise. So now, in the situation like this, rising in debt and significant increase in your official reserve, you might end up in a turmoil. It will reach time where even international creditors will be scared to give you some more debt because they are not even sure that you will be able to repay back the debt plus its interest. Remember, every single borrowing is accompanied by an interest payment. That because interest is the cost of any debt. So, increased borrowing, it will increase interest expenses. The significant decrease in the official reserve plus an increased borrowing will jeopardize the position of your country in an international level, be in economic perspective or political. And it might even cause some uncertainties or some instability in the country. Why the instability will happen? Because an excessive borrowing accompanied by significant decrease in the official reserve might cause a loss in confidence. And a loss in confidence by investor to your country will further trigger an investment outflow. That is, all foreign investors in your country will go away and invest in some other countries where the environment is friendly and conducive. So, following the turmoil, investors, for example, may run to countries such as Kenya, Uganda, Rwanda, South Africa, etc. They want to continue to invest or to do business in your country. Now, the investment outflow will further cause the current country's exchange rate to decline. The exchange rate of your country's currency will depreciate relative to other countries, because also you will no longer have some more goods to export. Rather, you will be in need of imports. So, financing import, as I mentioned earlier, again, is expensive. This can translate itself into further and further debt, and if not careful enough, even an economic recession. Again, even before you hit the recession, if you continue with this turmoil, you're going to observe a significant budget deficit, because we expect to do business and earn some more profit in order to finance our own budget. Now, if you can no longer export, if foreign investors are going away, leaving your country, if you import more than exporting, you're going to have a serious current account deficit, and subsequently you won't be able to finance your budget. So you're going to end up as well with the budget deficit as well. A persistent surplus is regarded as a favorable situation for a country because it allows a country to do the following. Number one, to encourage some foreign investors to come and invest in our countries. Remember earlier I mentioned that foreign investors will never come to our countries simply because a president, certain politician, or somebody have just invited them. Of course, they will receive the invitation, but before deciding on whether to accept or decline, they will have a meeting, let's say a board meeting. And in this meeting, one of the issues that they are going to scrutinize will be the balance of payment of the inviting country. However, there are some other issues that they will as well scrutinize, such as political risk. And the political risk also have a lot of issues. The level of government stability, the level of corruption, institutional stability, peace and harmony, political stability, democracy, rule of law, etc. A number of issues. But whilst forgetting, the balance of payment will be scrutinized. So if the balance of payment is healthy, like the country has a favorable balance of payment, that is surplus, investors will be encouraged to come and invest in that country because they know that the country economy is good, it's covered. Again, with the surplus balance of payment, you will be able to repay any foreign debt without having to use the official reserve. Remember earlier again I mentioned that if you have a significant deficit of the balance of payment, you will end up financing imports using either foreign debt, that is foreign borrowing, or you're going to use the official reserve, and sometimes even both. But if the balance of payment is surplus, then you do not have to use the official reserve to repay your foreign debt. You will simply use the excess funds that you have. And if it is even more surplus, more fat account, balance of payment account, then there won't be any need for you even to borrow funds from abroad, because you're kind of self-sufficient. The image mirror of a persistent surplus is a persistent deficit. So, a country cannot have both balance of payment surplus and deficit at a time. It's either you have balance of payment surplus or deficit. Now, if you have been maintaining a balance of payment surplus for a very good number of years, it means your trading partners are maintaining deficit balance of payment. Now, if this continues for some time, it may cause a retaliation or economic conflicts. Why? Because your partners or your trading partners are also looking to improve their balance of payment. So probably they'll start doing some restrictions of towards the product that you export to their countries in order for them to improve their balance of payment position. And that can lead to a serious economic conflict. Let's see the structure of the balance of payment. A balance of payment composed of 3 sections. First is the current account. Second, the capital account. And third, the balancing item. But in some other literatures, the balance of payment composes of 4 accounts. That is, the capital account. After the capital account, they consider another account here called financial account. Okay, they consider another account here called financial account. But in this session, we're going to cover all these 4 accounts. Don't worry. Now, the first account that I mentioned is the current account. The current account consists of 2 subgroups. That is the mechanized or trade account and the invisible account. The mechanized or trade account includes export and imports of goods and services. Exports of goods is recorded. Again, exports of services is recorded. At the end of the day, you will have a total of export of both goods and services. Then the same account records the imports of goods, the imports of goods and the import of services. And later on, we come to compute the balance of trade. So, balance of trade is the difference between export of goods and services vis-a-vis imports of goods and services. For example, let's assume that country A has the following data for exports. Okay, export of goods, it's 200, and export of service is 90. This gives us 290. Same country has the following values for imports. Okay, imports of goods 100 and imports of services 85. So this one totals to 185. But look, export of goods and services brings money into the country. So this is funds inflow. This is inflow. While imports draws money from the country. Therefore, this is outflow. Now, to get the balance of a trade, you need to find the difference between these two. Now, since the imports is fund outflow, it's negative. Let's put brackets. Now, to get the balance of a trade, you have to take the value for exports, which is 290, plus the value for imports, which is 185. Now, if you do the math here, you'll get the answer. Now, in the same account, there is invisible account. Invisible account records services and transfer payments account. The service account records all the services rendered and received by residents of a nation. And what are the services we're talking about here? Can be banking services, insurance charges, interest on loans, tourism expenditure, transport charges, or services offered by government institution. So again here, remember, if it was inflow, that will be negative, positive, and if outflow, negative. That is to say, if it is our country that has import service, that will be an outflow of funds. But if it is our country that has exported services, that will be inflow of funds. Conversely, transfer payments consist of remittances, gifts, and donations. Remember earlier I mentioned something about residents of country. We have some Tanzanians who lives abroad. All right. Let's say they are in the UK. These individuals, from wherever they are, they remit funds to Tanzania. All right. But also within Tanzania, there are some citizens of other countries. Okay. Now, the citizens of other countries who works in Tanzania remit funds to their respective countries, let's say to China, Japan, US, India, etc. So, remittances, you might have an outflow and you have an inflow. So, positive, negative. Then you need to find the difference. There can be some gifts as well as donations or grants. If your country has offered a grant, that is cash outflow. If it has received a grant or donation, that is funds inflow. Now, the next account is termed the capital account. Capital account records purchases and sales of assets such as stocks, bonds, etc. This account records capital inflow and capital outflows. The capital inflow refers to expenditures made by residents of foreign nations to purchase real and financial capital from the residents of a nation. Capital outflow simply means expenditures made by the residents of a nation to purchase real and financial capital from the residents of foreign nations. If we buy, let's say, some bonds, or we buy some shares from that are traded in a financial market, let's say in the US or in Japan, whatever. If the money flows out of Tanzania, out of our border, then that is considered as the capital outflow. But if it's the foreigners, okay, individuals from different countries buying some stuff from our country, it means we have funds inflow. Okay, so funds inflow is positive while fund outflow is negative. All right. Sometimes the government embarks into some massive project, for instance, the SGR project. The SGR project utilizes very few items from our country. Most of the items are purchased abroad. The technology, the expertise, that is service, because the company that has been given this contract is not domestic-based company. This company came from overseas. So the expertise, we pay for the expertise, we pay for the technology used, we pay for materials such as the steel bars, the train, etc. So all these entails cash outflow. Some few years ago, we purchased 7 brand new aeroplanes from Boeing, from Airbus, from Bombardier. All these withdrew money from our country. So it's being recorded in the capital account. That there is one to say. The account consists of all such items as may be employed in financing both imports and exports, namely private balances, assistance by international institutions and agencies, change in official reserve, and balances held by the government account. The capital account surplus, that is net capital inflow, is when the receipt from the sale of stocks or bonds exceed the payment for own purchases of foreign assets. Net capital inflow, that is a positive figure, is achieved when businesses or individuals from abroad have purchased a lot of assets from our country than we've done to than we have purchased some assets from their countries. That is what we call net capital inflow. For example, let's say bonds and any other financial assets. Let me put it this way. Financial assets that were purchased by the Tanzanians are worth 200 million. And financial assets that individuals from other countries have purchased from Tanzania are worth 150 million. Here you see that the difference is 50 million, meaning that cash outflow is greater than cash inflow. More funds have flown out of Tanzania's borders than the fund that has flowed inside the Tanzanian border. So this one is not healthy. Now, the last account is the balancing item. Balancing item arise because of errors and omissions in collecting statistics for the account. You know, the balance of payment records all transactions that your country have done in a specific accounting year. That's the reason we have a balance of payment for every single year. Like for instance, 2020, 2021, 2022, etc. So collecting statistics, collecting informations of all the transactions that the country have made is extremely tedious work. It's not something small or simple that someone can accomplish just like that. There are a lot of mistakes. That can occur. And that is what called errors or omission. Omission, that means some information or statistics were never included. Errors can be improper recording. That is, instead of, let's say, writing 3, somebody wrote something else. Now, to correct the error, we use the balancing item. The balancing item consists a residual category needed to ensure that all debit and credit entries balance, in the sense that the balance of payment sums to 0. Remember, I mentioned to you that every credit entry of the balance of payment needs to have a corresponding debit entry. Now, if a certain entry was wrongly recorded or was omitted for some reasons, we use the balancing item to rectify the error so as to ensure that at the end of the day, the balance payment will sum 0. The overall balance is the sum of the current and the capital account. If both the current account and the capital account are in surplus, then we can confidently conclude that in that particular financial year, we have achieved a surplus balance of payment. When a deficit in the balance of payment occurs, official financing needs to be positive. That is when now we introduce the official reserve in order to finance a deficit. Official reserve comprise of the following: monetary gold, special drawing rights at the IMF, the reserve position of members in the IMF, holding of foreign exchange, and the control of the monetary authority. The IMF allocates some special drawing rights to its member countries, usually on quarterly basis. However, that can change. That being in place, a country can run to IMF and use the special drawing rights to finance its deficit. But in some other instances, there are some countries that are wealthy enough to provide some loans to the IMF. Now, if that one occurs, then the IMF will consider it as a debt. And so, that is what we call the reserve position of members in the IMF. Now, this one can as well be converted into the special drawing right and later on be used by the country to finance its deficit if the need arises. Now let's discuss the equilibrium and the balance of payment. The balance of payment in the accounting sense must always balance. Debit must always equal credits if the entries are correctly made. Otherwise, if the sum of the current account, capital account, and the balancing item are negative, it will be balanced by a positive official financing, making the account sum to 0. A country's balance of payment is said to be in equilibrium when its receipts are equal to its payments on account of its transactions with other countries of the world. Equilibrium is a situation where you do not have some sort of excess. I think this illustration is kind of wrong. It is inclined to the right. Okay. We say that items are at equilibrium when they are at the same level. Okay. So if here is 5, then here is 5 as well. We can say now it is balanced. It is at the equilibrium. But in case that a country's receipts exceeds what the country has just paid out, then we can never achieve the equilibrium. Equilibrium is achieved when everything equals. A country with equilibrium balance of payment is often called a country in external balance. Balance of payment equilibrium occurs only when official financing is 0. A deficit or surplus in the balance of payment causes an economic disequilibrium. You see now, a deficit or surplus in the balance of payment cause economic disequilibrium. Now, depending with the direction, this economic disequilibrium may have a positive or negative effect. But if it is a positive, that is surplus. If it is surplus is never of much concern, because surplus means that a country is doing fine. So here we are very much concerned with the deficit, because a persistent long-run disequilibrium that is caused by deficit cause what is called a fundamental disequilibrium. So surplus is not a big issue. A fundamental disequilibrium has to be financed through the use of official reserve and overseas official borrowing. Now, what will be the ramifications of this? What will be the main problem of this? Having a prolonged balance of payment deficit, a country might face a serious prolonged budget deficit. Now, a country with a serious prolonged budget deficit will need some borrowings. Now, this will be external borrowing in order to finance government expenses. Otherwise, the government won't be able to run its operations. Why external borrowing? Because internal borrowing cannot suffice. Again, the deficit of any kind can as well be financed by the official reserve. Now it comes to the question, how much official reserve do you have in order to finance the deficit? If the official reserve is sufficient enough, well, otherwise you may become overdependent on the external borrowing. Now, external borrowing is expensive because you have to pay the loan with its subsequent interest. And if you rely on borrowing, creditors plus any other investors will lose confidence to your economy, to your country. The loss in confidence can not only cause political turmoil, but also an economic crisis. Now, economic crisis plus some political turmoil can lead to some serious civil unrest. No one will clap your hand for you if they are hungry. No one will smile good for you if they are unhappy with the way you are running things. See in some countries the way they experience massive protest. Recently, there is a country in Asia. This country is a monarch. They want the king to vacate the throne. They want the king to give up the leadership. Why? Because people are unhappy with their economy and the political situation. So you see, something small can trigger something bigger. No one will ever be happy with you if they are hungry. Now, let's focus a little bit on the terms of trade and the balance of payment. What is the terms of trade? Terms of trade simply means the extent, or it represents the extent at which export finance import. The term of trade measures the rate at which countries' products are exchanged for the products of other countries. In any given country, remember in international trade, we export, that is, we sell goods abroad, but at the same time, we import, that is, we buy goods from abroad. So goods that are exported needs to be accounted, and also goods that are imported needs to be accounted as well. Now, this can lead to a situation where we say the terms of trade is favorable or unfavorable. In what situation do we say that the terms of trade is favorable? And in what situation we say the terms of trade is unfavorable? First of all, we need to understand how do we compute the terms of trade. Terms of trade is computed by taking the ratio of the volume of imports to that of exports. Multiply this one by 100 in order to get your answer in percentage. Now, you see here, exports to import. If you export more, let's say 10,000 billion, that is exports for a specific financial year. And what about imports? Imports, let's say 200,000. Okay. If this is the volume of export and this one the volume of import, then TOT can easily be obtained by dividing this figure. If you do the math, you'll end up with a favorable terms of trade. And a favorable terms of trade has a positive significance on the balance of payment. It improves the current account. What if the volume of imports exceeds that of export? For instance, what if the volume of import is 40,000, whereas the volume of export is just 10,000? In this situation, the TOT is going to be 10,000 by 40,000. So in this situation here, you see that you're going to end up with unfavorable terms of trade. Now, unfavorable terms of trade, again, has a negative impact on the balance of payment. Now, this will have some kind of multiplying effect. You know, it won't only affect the current account in the sense that the current account is going to be deficit, but even the exchange, okay, the exchange rate of the domestic currency against foreign currency will be hampered, affected by the negative or the unfavorable terms of trade. Now, due to the importance of the terms of trade and its implication to the country's economy, a government may want to influence its value. Why? Remember, the favorable terms of trade is not of much concern, but unfavorable. Unfavorable has a serious effect on the balance of payment. So in some occasions, if it's not that much bad, in some occasions You may let it correct by itself. However, in some instances, it might take so long. But if the situation is worsening, then the government needs to interfere. So the government may interfere in order to improve the terms of trade by doing the following. Number one, influencing the exchange rate. And number two, by trying to reduce the domestic price inflation through tight monetary or fiscal policy. And by doing so, the terms of trade will improve. How can you do this? By influencing the exchange rate. Just recall the formula. Terms of trade is a ratio. Okay. Terms of trade is a ratio of the volume of export to that of import. The extent at which export finances import. Now, what are the issues that can cause your country to have massive or to experience massive exports? Quality goods is one of an issue. Price of the produced goods and services is another issue. So, speaking of the prices, if the government, for instance, devaluates its currency's exchange rate, what will happen? Produced goods and services from your country will be cheaper to the trading partners. So as long as they are quality goods, the demand will be high. The demand will increase because they are affordable to almost everyone. And by doing so, you will improve the terms of trade because now you're going to export more and more and more and more and use the export proceeds to finance imports. That way, you improve the terms of trade. Trying to reduce domestic price inflation through tight monetary or fiscal policy. Inflation, persistent increase in the general prices of goods and services. That's inflation. Now, if there is inflation in your country, how do you deal with it? Execute contractionary monetary and fiscal policy. By executing the contractionary monetary or fiscal policy, what's going to happen is that there will be scarce of funds or money in circulation. Prices will improve. And by removing inflation, your country can as well become attractive even to some investors. Now we've seen that it may happen a situation whereby the balance of payment is at equilibrium, but imbalance can as well occur. Now in case of the imbalance, how do we deal with it? Either deficit or surplus, it is imbalance. Why? Because it causes a disequilibrium. So, if there is a disequilibrium, the government ought to respond. Correction of an imbalance, therefore, involves influencing specific element within the balance of payments account in order to limit or remove the disequilibrium position. Now, let's assume that we have a disequilibrium due to some issues at the current account. Now, how do you correct the current account deficit? in case of the current account deficit, first of all, I need you guys to try to recall what are the contents of the current account. And the current account, we say this account records the exports of goods and services and the imports of goods and services. But also there are some remittances, donations, and gifts. In most cases, the major contributor of the current account are exports, the level of exports and imports of goods and services. Remittances and donations are small contributors. Now, by devaluating the currency, the domestic currency, what's going to happen? The price of exports will be affordable to countries, to residents of other countries who purchases goods and services from your country. We devaluate to sell more. Devaluate to sell more. So simply say we devaluate to export more. Now, current account deficit occurs when, if I'm to consider these two accounts, that is export and import of goods and services, so it occurs when imports, the level of imports exceeds that of exports. By devaluating your currency, your products will be cheaper. That means now you will be in the position to export some more and earn a lot of funds that you can use to finance the volume of imports. So devaluate in order to sell. But also we can use demand management policy. That is, the volume of imports can be reduced through policies designed to reduce imports, which include reducing money supply. By reducing money supply, the residents of your country won't have a lot of funds to spend. Again, you can reduce government expenditure. This is from the fiscal policy. This one comes from the monetary policy, money supply, monetary policy. Government expenditure, fiscal policy. If government does not spend, there won't be available funds to the public for some more expenditures. That way, you will be discouraging import. So you see, the point behind here is to discourage the level of imports. If money supply is reduced significantly, if the government reduces government expenditure, and at the same time increasing tax, okay, automatically here you will discourage significantly the level of imports. Remember, some few years ago in our country, we came with a famous phrase called Vyuma Vimekaza. Why did we come up with this famous phrase? Money supply was significantly reduced in the country. Likewise, government expenditure were cut off. Tax was never raised. Rather, policies to ensure compliance to the taxes were strengthened. Due to austerity measures undertaken by the government, I remember it took a lot of time to see plate number changes on the motor vehicles. I think you guys remember. Nowadays, I see plate numbers changes every now and then. After 2-3 months, you'll see a new number, plate number. But in some few years ago, situation was different. We were unable to import as many cars as we can. Why? Because of liquidity issue in the country. And why did we experience the liquidity issue? It's due to the austerity measures that were taken by the government, such as the reduction in the money supply and government expenditure, as well as strengthening laws or regulations that oversees tax collection. So, if you devaluate your currency, you will be promoting export. If you exercise demand management policies, government austerities, by reducing money supply, government expenditure, or increasing taxes, then you will significantly discourage imports. Now, if imports, the level of import is lower than the level of export, automatically the balance of trade will be corrected. Again, with the current account, you can use direct control to reduce imports, involving limiting the volume of import through tariff or import quota. We discussed about the tariff. We discussed about the quota. The volume of goods that is allowed to enter a certain country in a given financial year, that's quota. But tariff, that's some custom formalities, custom fees that one needs to meet or to pay when they're importing. But if you if you exercise these tariff and import quotas, you'll be in a danger of entering into an economic war with some other countries, particularly those countries that you are trading with. Because those countries as well may retaliate. I'm sure you guys must remember some few years ago, we banned some flights. Okay, some flights from our neighbor countries were banned to come into our country. And the neighbor country responded by banning some flights from our country into their country. So that is called retaliation. You do this, we do this. Tariffs. Some tariffs were imposed, and all neighbor countries responded negatively, thereby imposing some more tariffs and quotas. And what happened? Massive of volumes of goods stuck at the borders. There were a very long queue of trucks that carried goods from these countries at the customs at the border due to retaliation by neighboring countries. Exchange control involving limiting the use of foreign currency by domestic residents to purchase goods and services from overseas. That can as well be used to correct the current account deficit. So here, technically what you do is to discourage, okay? You discourage imports. Again, encourage overseas investment in the country. Create conducive environment for foreign direct investment, for foreign investors to come and invest in your country. Once they come and invest in your country, production of goods and services will increase, and so will the volume of exports. That's the reason we have issues or areas such as EPZ. Why do we have this? we create these regions in order to attract these foreign investors to come into the country and take advantage of those areas in order to invest, knowing that at the end of the day, we will benefit. So it's a win-win situation. But again, you won't be benefiting from exporting goods that are substandard. You need to improve the quality of domestically produced goods and services for them to be highly competitive at the global market. I mentioned this area that lowering price alone is not enough. Lowering price needs to be accompanied by the quality of goods or services that you offer overseas. But also reduce government net payment to overseas diplomatic commitments. I don't want to talk much on this, but again, you guys must remember some few years ago, our government adopted this policy. If some ministers wants to go abroad to attend some meetings, instead of taking a delegation of 20 people, 1 or 2 individuals were enough to accompany the minister. In some meetings, the government never entertained excessive expenditure of public funds. All that was done in order to ensure that we will be able to correct the deficit that was not on the current account. In case of the surplus of the current account, as I mentioned earlier, surplus is not a big deal unless otherwise it has been left to stay for quite some time. Appreciating the exchange rate, that is, by raising the exchange rate of the domestic currency relative to the currencies of your trading partners, will correct the current account surplus. How? For example, if currently the exchange rate of Ugandan shillings for Tanzania shillings is, let's say, selling 10.5. That is, one needs 10.5 Ugandan shillings in order to acquire 1 Tanzanian shillings. Now, if at this exchange rate, the level of exports of some grains to Uganda was, let's say, 100,000 tons per month, and the exchange rate or the value of the Tanzanian shillings is increased, so it has appreciated to the extent that now the exchange rate is 20 Ugandan shillings for a single Tanzanian shillings. What will happen here? Ugandans won't be able to afford to import the 100,000 tons of grains per month. This volume will decline. So, by raising the value of your domestic currency, technically you are discouraging export, or you are discouraging the importers, that is, trading partners who buy goods or services from your country. they won't be able to purchase goods and services from your country any longer, because it is more expensive for them. And by doing so, the level of exports from your country will decline, and so will the surplus. Again, you can raise domestic demand by pursuing expansionary monetary or fiscal policy. If you pursue expansionary monetary or fiscal policy, your residents will have a lot of money at their disposal. Now, if they have a lot of money to dispose, most likely they will buy these domestically produced goods and services. Again, if there were some import controls such as tariff or import quotas, then you need to abolish them. By taking away these import controls, again, you will manage the surplus. Now, remember, another account of the balance of payment is the capital account. Now, in case there is a deficit of the capital account, what do we do? First of all, you need to understand deficit at the capital account occur when there is net cash outflow. Okay, deficit occur when there is massive fund outflow from our country. Okay, for instance, if the government has embarked into some massive project, such as purchases of some planes, brand new planes instead of leasing, construction of hydroelectric power dam, construction of the SGR, buying of some bonds, euro bonds, some stocks or shares, these activities withdraw funds from our country. So a lot of foreign currencies will be withdrawn from the country. That will cause what we call net outflow. Now, in the situation of the net outflow, what do you do? Number one, raise the domestic interest rate. And remember, the policy that influence interest rate is the monetary policy. So pursue contractionary monetary policy in order to raise the interest rate. What will happen if interest rate is raised, let's say, from 4% to 6%? It will be attractive for foreign investors to come and invest in our country simply because they will be paid more. So raising of the interest rate will attract foreign capital inflows. Foreign investor will be happy to invest in some assets, financial assets that are traded at the domestic financial market because of the interest of the profit that they will realize once their investment matures. Stabilizing the exchange rate to discourage speculative outflow. Speculation can play against you or in your favor. So, if speculation plays against you, then you'll have capital flight, excessive funds outflow. So ensure that there is exchange rate stability. And that's the reason you see the central bank has this policy to ensure the stability of the exchange rate. The government needs to provide incentive for the foreign investors to come and invest in our country. And how can the government provide this incentive? It's through exemption, through tax holidays, through provision of subsidies, and even giving them some grants. So for instance, if there are some tariff at the port, okay, tariff imposed for some imported goods, the government can waive some of the tariff or some of the taxes so that the investors will be attracted to come and invest in the country. Tax holidays, that is, once an investor has come and invested in your country, you give them some few years that not necessarily they do not have to pay the entire tax, but at least they will pay an affordable tax, a certain portion, so that they can very well establish their businesses in the country, and after some times, then they will start paying tax same as other investors. That's what we call some tax holidays. You excuse to pay tax for a specific period of time, and once you are very well established, like now you've already built sufficient infrastructure, you have captured the market and everything, you start paying normal tax, just as other companies or other individuals. Let's wind up by checking the summary of some issues or issues that may cause the balance of payment to be deficit, or issues that may lead to a deficit balance of payment. Number one, there can be some economic factors such as developmental activities. Developmental activities, for instance, construction of some massive project, okay? Massive project, particularly if instruments, equipment, and expertise, technology are imported. This will ultimately withdraw funds from the country. If you import technology, if you import expertise, if you import equipment that you use for some massive project in the country, a lot of funds will go outside, and so expect to have a deficit. A serious inflation will discourage foreign direct investment to your country. Therefore, foreign investors will shy away from your country. They won't come to invest. Cyclical business fluctuations, particularly that which can cause or can indicate some sort of recessions. Remember, business goes down, goes up, sometimes down, sometimes up, sometimes down, right? So here, the interest is this part, where business makes loss instead of profit. So this one can as well cause some deficit. Change in demand. You export a certain product to some countries abroad. Let's say you export a lot of cotton. No, okay. Let me give you a practical example. Some few years ago, the country used to export sisal. So sisal were used to create some bags, okay, which could keep grains. Sisal were used again to manufacture ropes, and ropes were used to tie stuff up. But Due to some invention of the new technology, then from Europe, they invented plastic bags, plastic ropes, which are considered durable. They can last longer than the ropes made out of sisal or bags made out of sisal. To date, you no longer see any bag or rope made out of sisal. At least as for the ropes, still you can see some ropes that are doing some small jobs. But as for the bags, back then you'll see a bag of rice, a bag of corn, a bag of beans made out of sisal. They no longer exist. Why? Due to an invention of technology, now we have the plastic bags. So that being the case, you see the volume of export of sisal from our country to some other country significantly declined. Declined due to what? Due to change in the demand of sisal products. Import of services. If your country import services, doctors, teachers, engineers from abroad, all these people are paid, and they are paid at an expert level, paid using the foreign currency plus some other benefits. So by paying them or paying for their services, it means funds goes out. That is outflow. It may lead to the deficit. Another factor for the balance of payment deficit is the political factors. Now, political factors can be political instability or political disturbances. Political disturbances are some changes of the governing laws by the parliament. Today, you say this, and tomorrow you tell an investor something else. Today you say these are our laws regarding to extraction of gold, let's say, from our country, and tomorrow you change the law. You say something else. So investors are scared. They will never come to invest in a country where things change overnight. Political instability, poor democracy, civil unrest, unfair election like rigging of election, etc. All these can lead to some violences. So no investor will want to invest in a country that is prone to violences, because political violences can lead to civil war. And civil war is bad for business. So in case of political instability or political disturbances, expect these foreign investors to go away. Those who are already in your country will move their businesses or their investments somewhere else, and those who are not in your country will never be attracted, even tempt to come and establish businesses in your country. Social factors. Social factors can be demonstration effect, like a country is open to some foreign citizens. Now it's a mix. You have, let's say, Tanzanians living with Kenyans, living with Indians, with Chinese, with US Americans, with British, etc. And guess what happened? Lifestyle. Since the citizens of these countries have a different lifestyle, Tanzanians want to adopt their lifestyle. So they tend to import some clothes from Italy, from India, from China, mobile phones, motor vehicles, etc. So if they continue with the habit of importing goods from abroad, automatically you'll end up with a lot of imports and rather than exports. And now you know what's going to happen there. Change in taste, preferences, fashion, and trends of the consumer can as well affect the volume of exports of your products. And so you're going to end up, or you may end up with the deficit. Now, let's finish by looking at this question here. The question reads, the balance of payment data for year 20,000 for a hypothetical country EAC are shown in the table below. Goods exports 40, imports of goods 30, services exports 15, imports of services 10, net investment income 5, net transfers 10, balance on a capital account 0, foreign purchases of assets 20, and countries purchases of assets abroad 40. Required, calculate the balance on goods and services, and the balance of capital and financial account. So you see here, we've been given a balance of payment of an hypothetical country which has these items. Remember, I mentioned to you earlier, when you see positive sign, it means it is inflow. And when you see a negative sign, it means outflow. Cash outflow, funds outflow. That is the meaning. Now, you are required here to compute balance on goods. Now, how do we get balance on goods? From the current account, we know that the current account has export of goods and services and imports of goods and services. Therefore, the difference between export and import of goods and services is what's going to give you balance of goods. The difference between export and import of services is going to give you balance of services. Again, the difference between the volume now of exports and imports is going to give you balance of trade. Now here, we're required to compute balance on goods. Now, goods here, or the value for goods, are 40 for export and 30 for imports. Therefore, here we can confidently obtain the balance on goods by taking the amount for exports minus imports. But imports of what? Of goods, export of goods. Now, export of goods is 40. And imports is 30. Therefore, here you're going to end up with what? 10. So balance on goods equals to 10. And what about balance on goods and services? Now, balance on goods and services, that is kind of balance of trade. So you need to sum all exports. Then you subtract all imports. Since here it says balance on goods and services, so sum the exports of goods and services. Now exports of goods is 40. Again, export of service 15. Now this one is going to give you 55 minus imports. Imports of goods is 10 and imports of service, imports of service is 10 and imports of goods is 30. So here you're going to end up with 40. Now 55 minus 40 equals to 15. Therefore, balance on goods and services equals to 15. Last, balance of capital and financial account. Now, the balance of capital and financial account will be the difference between the inflow of funds and the outflow of funds. Now, here we need to examine the capital account. So, what transactions here falls under the capital account? Foreign purchases of assets. Now, foreign purchase of assets imply that individuals or investors from other countries purchase some assets from this country. So that entails cash inflow. That's going to be 20. Minus EAC purchase of assets abroad. Now, this BoP, this is the BoP of EAC. The country here is EAC. Now, here we see that the residents of this country have purchased some assets abroad. Those assets are worth 40. Therefore, here the balance is going to be 20 but negative. What does this entail? You see now here, on the balance of capital and financial account is negative 20. This is deficit. Balance on goods and services is a positive 15. It is surplus. And the balance on goods again is a surplus because it is positive 10. That's how we deal with a question that appears like this. Otherwise, today we stop here. This marks the end of this presentation. I really appreciate for your time and patience. Thank you.